As we know that put call parity is a very powerful expression in option pricing. Now we extend the put call parity concept to include forward or futures. We can do it with forward contracts, we can do it with future contracts, and we can construct synthetic futures with options. Let's have a look at put call futures parity that is there in table 8.5. Now here we have two portfolios. Portfolio A is a long position in futures on the underlying, and it also has a long position in a put on the underlying. Portfolio B has a long position in the call on the underlying and a long position in bonds that have a par value equal to the difference between the exercise price and the future price today. And as we know that these are discount bonds, so we have the present value calculated as the difference of the exercise price and the future price. Now, there are two possibilities at expiration. The stock price at expiration is less than the exercise price, and the stock price at expiration is greater than the exercise price. Now, we know that futures have symmetrical payoff. That is, whether there is a gain or a loss, they must be settled. So here, when the stock price at expiration is less than the exercise price, we have a long position in the future, so we will pay the future price and receive the underlying, which is priced at ST, which is less than X. And when ST is greater than X, even then it doesn't affect the settlement of the future. We still have to pay the future price and we will receive the underlying, which is worth ST, and ST here being greater than X. However, for the put, the stock price at expiration is important, because if the stock price at expiration is less than X, it will be in the money, so it will be exercised and we will sell something that is worth ST for X. So the difference between X minus ST is the payoff on the put option. However, when the stock price at expiration is greater than the exercise price, the put will expire out of the money. We will not exercise it. So the payoff will be 0. And if we net the payoff here for portfolio A in case 1 and case 2, we see that in the first case here, ST positive and ST negative, they cross, so we are left with the exercise price and the future price. So the payoff is X minus the future price. And here we see that the put payoff is 0, so the payoff of the portfolio A is solely derived from the payoff of the future, which is ST minus the future price. Then for portfolio B, again, it's important for the call that whether the exercise price is less than the stock price at expiration or not. So in the first case, when the stock price in the market is less than the exercise price at expiration, so the call is out of the money and we have a 0 payoff for the call. Then when the stock price is greater than the exercise price at expiration, we see the call is in the money and we buy the underlying, which is worth ST at expiration for a price that is X. Similar to the future payoffs here in portfolio A, the bond payoffs are not dependent on the stock price at expiration. So no matter whether the stock price at expiration is less than X or more than X, the risk-free investment in bonds will mature to the par value, which is equal to the difference between the exercise price and the future price in this case here as well as in this case here. So the net payoff for portfolio B is equal to X minus the future price here and ST minus the future price here. If we compare the payoffs from portfolio A and portfolio B, we see that they are identical. So we can now say that buying a future contract and buying a put option on the underlying is equal to buying a call option on the underlying and investing uh, in the risk-free bonds that have a par value equal to the difference between exercise price and future price. And of course, we are talking in terms of present value. Now we can see that buying a future and buying a put option is equal to buying a call option and investing in risk-free bonds with par value equal to the difference between the exercise price and future price. This is because the payoff here in case 1 from portfolio A is exactly equal to portfolio B payoff. And similarly, in this case, the portfolio A payoff is exactly equal to that of portfolio B. So we have this equation here, which is the put call futures parity. If we rearrange this, we get this expression, which is buying a call option on the underlying and selling a put option on the underlying is equal to borrowing the present value of the difference between future price and exercise price. Now, be mindful that when we rearrange, when this term goes to the other side of the equation, the x becomes negative and the future price becomes positive. If the exercise price is chosen such that it is equal to the future price, in that case, this term will become 0. And when this side becomes 0, we can then have a synthetic future which is replicated by a long position in a call and a short position in a put. And for that, the requirement is that the exercise price must be chosen such that it equals the future price, so that this side of the equation becomes 0, which is the value of the future contract when it is initiated at time 0 here. So we can synthetically replicate a long future position, this one, by buying a call option and selling a put option on the underlying, where the exercise price is set to the future price in the future contract. Now here is a numerical example which uses the S&P 500. Let's suppose on May 14 the S&P 500 is at 1337.8. That is the spot value for the index. And the June futures are trading at 1339.30. The June 1340 call is selling at a price of 40, and the June 1340 put is selling at a price of 39. The expiration of the contracts will be on June 18. So there are a total of 35 days from May 14 till expiration. So T will be equal to 35 divided by 365, that is 0.0959. The risk-free rate is 4.56%. Now, the price of the put is given to be 39. So we need to calculate the price of the call plus the price of the risk-free bonds, where the par value of the bond is equal to the difference between the exercise price and the future price. So the price of the call is given to be 40. The exercise rate in the calls and put is 1340, so that is 1340 here, and the future is trading at 1339.3. So if we calculate the present value of the difference between these two and add it with 40, it is 40.7. In other words, the present value of the bond is 0.70. So one side of the equation, that is the future plus the put, will have a total value of 39, while the other side of the equation, the put call parity, has a total value of 40.7. So we can readily see that the future plus the put is undervalued relative to the call plus the bond. So we should buy the put and the future contract and sell the call and the bond. However, we are ignoring transaction costs here. Now, if we want to value options on futures, we have to see the boundary conditions for calls and puts on futures. So we start with the American options here, and first we look at the call. So the minimum value of an American call on futures will always be greater than the maximum of 0 or the future price today minus the exercise price. Similarly, the minimum value of an American put on futures will be equal to or greater than the maximum of 0 or the exercise price minus the future price today. We already know that the price of any option, call or put, is equal to intrinsic value plus time value of money. For the lower bound value of a European option on futures, we follow the same approach as we did for equity options in our discussion in chapter 3. So let's have a look at table 8.6 for calls. Now here we have two portfolios. Portfolio A is consisting of a long call on a future. Portfolio B consists of a long future position and a long bond position. So the current value of the long call in portfolio A is equal to this, and the long future will have 0 value when it is initiated, and the value of the bond is equal to the present value of the difference between the future price and the exercise price. So this is the par value of the bond which will be received at maturity. Now again, there are two possibilities: that at expiration the future price at expiration is less than or equal to the exercise price, or the future price is greater than the exercise price at expiration. As we know that these options are on futures, so the underlying here is the future price, not the spot price of the stock at expiration. So this is important to note. Now, if the future price at expiration is less than the exercise price or equal to the exercise price, the call on the futures will expire out of the money. You would not want to exercise the call because the future price is low and the exercise price is high, so it is better to buy the future in the market at that time rather than to exercise the call and buy it using the exercise price. when the future price is greater than the exercise price at expiration, then the call on the future is in the money. You should exercise your call, which gives you the right to buy the future at this price, and you have to pay this. Of course, these are cash settled. Then for portfolio B, we see that the long future will be independent of whether the future price is less than or greater than the exercise price at expiration. So the payoff will remain the same. So the payoff on the long future at expiration will be the future price at expiration minus the future price at which the contract was initiated. Similarly, here the payoff will remain the same. Then if we look at the bond, again, no matter whether the future price at expiration is greater than or less than the exercise price, the bond, because they are risk-free, they will mature to their par value. So the par value of these bonds is equal to the difference between the future price today minus the exercise price in the call option. If we compare the payoff for portfolio A and B in the two scenarios, we see in the first case portfolio A pays 0, and portfolio B has a payoff which is equal to the difference between the future price at expiration and the exercise price. Now this is negative because we know here that future price at expiration is less than X. So this payoff from portfolio B is negative. So it means portfolio A has a better payoff in this scenario from portfolio B. In the second scenario, where the future price is greater than X, we see the call is paying the future price at expiration minus the exercise price as the payoff. The same is the payoff for the portfolio B. Now, in this case, both portfolio A and B have the same payoff. So we see that in no case portfolio A is being dominated by portfolio B. A is as good as B, and in the first scenario better than B. This conclusion gives us the lower bound value of a European call on futures in this form. Table 8.7 is showing the lower bound value of a European put option on futures using the same approach as we did for the call option in table 8.6. It suggests that the lower bound value of a European put on futures is always greater than or equal to the maximum of 0 or the present value of the difference between the exercise price and future price. Now we can do the put call parity of options on futures, and for this we can follow the same approach by constructing two portfolios, portfolio A and portfolio B, comprising of puts and calls on the futures and the future itself, and of course a risk-free bond. Portfolio A has a long futures position and a long put position, and portfolio B has a long call and a long bond. Now the current value of the long futures is 0, as we know. At the start of a future contract, it will always have a 0 value. The price of the put is given by this expression here. For portfolio B, the long call has a price equal to this expression, and the bonds have a present value equal to the present value of the difference between the exercise price and the future price. Now we see there are two possibilities: the future price less than the exercise price at expiration and the future price greater than the exercise price at expiration. As we discussed earlier, no matter what, the futures will have the same payoff, that is the future price at expiration minus the future price today. Then the long put, however, will have a payoff only when the future price at expiration is less than the exercise price. Otherwise, whenever the future price is greater than the exercise price, we see that the put on the futures is having a zero payoff. A long call, on the other hand, will have a zero payoff when the future price is less than the exercise price, and will be in the money when the future price at expiration is greater than the exercise price. And similar to long futures, the long position in the bond in portfolio B will be insensitive to whether the future price is less than the exercise price or not. The payoff is fixed here in both the cases. Now, if we compare the payoff from portfolio A against the payoff from portfolio B, in both the cases, we see that they are identical in both the cases. So it means that buying a long future and a long put is equal to buying a long call and a long bond. And remember, we have futures as the underlying security in the put and the call, and the future itself is a derivative on the underlying stock. Now, if a call is deep in the money, it may be better to exercise it early, because in this case the call on future will behave almost identically to futures, because the delta would be nearly 1, and early exercise will free up some funds for the option holder, because the future position would not require him any cash. The margin requirement on the futures can be met by depositing interest earning treasury bills. Another logic behind the early exercise here is that the minimum value of European future call is always less than the exercise value of the American call. We can use the Blake model to value European call options and European put options on futures, and this is a slight variation from the Black-Scholes-Merton model. Here we see that the spot price today is replaced by the future price today. ND1 and ND2 are the same. The exercise price is the same. However, because it's a future contract that is the underlying in the contract, we need to discount the payoff of this. So we have to use the continuously compounded risk-free rate, and T is the time period for which we are doing the discounting. So the formula is identical to the Black-Scholes-Merton model, with the exception that we have the future contract as the underlying for this call. D1 is calculated in same way. However, here we have the future price as the underlying, and the exercise price is the same as was in the case of equity option. The other difference is here, as we are no more placing the risk-free rate here. In the case of equity option, it was the continuously compounded risk-free rate here plus the variance divided by 2. D2 is the same as was in the Black-Scholes-Merton model. So let's have an example that is given in table 8.9. So here we see the future price today is equal to 1401. Exercise price is equal to 1400. The continuously compounded risk-free rate is 5.43%, and the standard deviation is 0.21. Time to expiration is 0.1233. D1 and D2 are estimated, which are then used to estimate ND1 and ND2, and then plugging these numbers into the black formula for the call option on futures gives us the price of the call equal to 44.88. We can rearrange the black model for call option on futures to get the formula for put option on futures. So the put price is equal to the present value of the exercise price multiplied into 1 minus ND2, which is the probability associated with D2, minus the present value of the future price today multiplied into 1 minus ND1, which is the probability from D1.